we've come full circle. First of all, what was the first day like at Apollo? And what does it mean that the real yield, the 10-year real yield, is now back to where it was in 06, 07?
Well, first of all, thanks for inviting me today. I'm excited to be part of this great road trip. Taking you back down memory lane, Apollo was a much smaller business back then. We were probably 20 billion in assets. We're 650 today. The role of banks was much, much different. There was a massive risk appetite at that time in the world. But certainly if you go back, I think the world was very different. And I guess I would start out today saying, as you guys talk about, where real rates are, basically what you're really saying is the cost of capital has gone through a massive reversal. And so all the activity going on in the last 18 months between all the central banks of the globe, that was the mechanics of getting to this destination. But now we have the rebalance, we got out of balance. For 10 years, debt was priced way too cheap. And you were forced to go into equities, and basically debt subsidized a massive amount of equity returns. And so the last 18 months, the world now has about 300 trillion in debt on 100 trillion in global economy. Those numbers are up basically doubled in the last 10 years. And when you go from 0 to basically 4 or 5%, that's 10 trillion of borrowing costs that have to be absorbed. And so there's a massive balance going on between debt versus equity and versus balance sheets. So
folks, we're going to turn this into a 2-hour seminar, given where the markets are. We're arguing about that.
I'm not sure they want this to become a 2-hour seminar.
The answer is I'm going to let Lisa and John do the heavy lifting here. I got one more question, which is the memory of 1998, which was about leverage in the system. It was about shadows in the system. Now that we're back here, and with the first and second derivatives of how we got back here, where are the shadows now?
Well, certainly wherever there's an asset liability mismatch, SVB was a perfect example of that. People talk about regulation. It was just a simple, not how you operate a financial services business. Where are there ALM mismatches? Certainly I don't think it's in the world of private credit. I think it's probably a lot of consumer finance challenges around the globe right now. You've got way too much public debt right now. There's challenges. So there will no doubt be challenges over the next 24 to 48 months as you've got companies that have funded debt-laden balance sheets of companies that have funded growth CapEx, and they cannot pay the piper right now.
Everything you said in your opening remarks is what Lisa wrote about for the best part of a decade, right? Complaining about the previous regime. We're all trying to figure out if this is truly a new regime or just a moment in time that we move away from pretty quickly. Can we live with where real rates are right now? Can we live with that?
Well, I think that it's sort of reality. We're getting back. You say real rates. I say cost of capital. It's cost of capital for everything we do. If you think of the last 10 or 15 years, the growth of technology companies, the growth of biotech, there's some great companies out there, but they were funded with the equity had all the benefit, and the zero cost of debt is not really sustainable. So this is the real world right now. Real rates are going to be higher. The cost of capital as we go back to this balance. And I don't think it's a surprise this week, as we were talking about earlier, the FT op-ed by the two finance ministers of France and Germany talking about the European financial services sector and the role of banks. So there's a parallel path here, conversation about how companies finance, how they have access to capital, the role of savings and securitization. So it really is all tied together.
Although, are we really living with rates where they are? I mean, we take a look at these average rates, we see them in the numbers, but that's not what anyone's actually paying. Companies have already termed out their debt. So are we living with it, or are we going to see what it looks like to live with it in a year?
I think we're not seeing it. So to highlight that comment, the mechanism, the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. In the U.S., you have a mortgage market with 30-year mortgages at a 3% interest rate. You have the high-yield market with a 6% coupon and an 8-year duration. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical. I see a world where financial conditions have gotten tighter, and it's just a question of how long that transition mechanism which will probably be longer than it's taken in the past.
There are a couple different ways for us to get to something other than a soft landing. There's the crash and then rates going back down. And then there's something where it's just sort of a stagflation light or a stagflation proper, where rates remain high for a very long time and growth just slows substantially. It seems like the market is leaning into the latter. How much does that change your perception of what's going to happen in the credit space?
Well, this conversation is going into one where we need to get Torsten here because he's the economist at Apollo, not me. But certainly what you're talking about is an environment where growth is more challenged, and with how do companies access capital with a new price of marketplace. Certainly you have challenge, whether it's in Germany or in the UK, with a slowing economic growth. But there's a variety of aspects that we would see. Unemployment, while still very low, it's going in probably a more challenging direction. Delinquencies are going up. Defaults are going up a little bit in the leveraged loan market and the high yield market. Recoveries are lower. So there's a lot of points that would say to you that there's going to be a more challenging, tightening financial conditions. But certainly for us, the U.S. has been quite strong. The U.K., there's still a lot of areas to lend. There is on Western Europe as well. So I guess the theme that I would take away from this is that we're going from a decade of a real imbalance where the equity was the big beneficiary, debt paid a crazy price. That balance has been completely changed 180 degrees. And now, how do companies navigate? How does the financial services, how do banks, how do alternative asset managers, how do we all balance and navigate this marketplace ahead of us?
Is this the return of the bond vigilantes then?
Well, I do think when people talk about when the central banks are going to actually lower rates, I think it will happen well before they actually get around to it, just like it happened on the upside in terms of rates. There's no doubt that one of the challenges of the last 15 years of the regulatory environment is you've had so much capital withdrawn from these marketplaces in terms of trading desk capital. So the amount of capital to trade $100 or $1 billion of 10-year treasuries right now, that has a greater impact. So there's no doubt that any kind of activity in the secondary markets will have a pronounced impact. And that's just the way of the regulatory impact post GFC. But for us, I mean, if you're in my seat at Apollo, there's been 4 trends since I got in the business. There's been massive technology improvement, there's been massive globalization, there's been massive deregulation, and the 4th, there's been a decline of interest rates. Other than technology, you're probably having those tailwinds be massive headwinds as an investor now. So how do you navigate that? How do you organize yourself? But I do think in terms of investors, it's a time to be
the technology change is the Bloomberg terminal. In case you didn't
Everyone needs a Bloomberg terminal. Is that the pitch? We're done.
Yeah, that's the pitch.
Okay, we're done.
Earlier in the conversation, Jim mentioned that joint op-ed that was in the Financial Times. The headline, for those of you that didn't read it, we must close the EU capital markets gap. Can you talk to me about how Europe goes about doing that? Because me, Tom, Lisa, this whole audience has heard that 1 million times in the last 10 years. How do we close that gap?
Well, I think let's talk about how we got here. We got here post-GFC, where a lot of tools that have been used to push risk out of the banking system that I think have been successful in some regions of the globe. The European regulators took a different view. They took a dim view of securitizations. I would argue that if you look at securitized product, that's actually been very good for the banking system in aggregate. It's pushed risk out to the real owners of risk. If you look at other things that they talk about shareholder activism, but I do think there's got to be an embracing of these types of tools to allow greater activity, because I think it's creating a bit of financial services stagnation.
Torsten Slot called me up one day and he said, you really ought to look at the Austrian piece. So I loaded the boat on the 97-year Austrian bond. That really has worked out well. I'm down like 70% or whatever. Tell me about what duration's going to do and choice of duration is going to do, given this new environment back to 06, 07, 08.
Again, when I think about the world, I think about long duration, but what we do at Apollo is we're really trying to figure out places where we're not taking credit risk or duration risk. I'm just creating great spread. So whether it's fixed income replacement, I certainly believe that the world has been on that textbook of if you want to make money in fixed income, you got to do duration. I think it's an interesting way to look at the world. I think you're getting paid right now on risk-free rates to some degree, whether they go a little bit higher or wider. I certainly know for us at Apollo, whether it's in the investment grade world, public and private, whether it's in private capital, when we can make high single digits, 10%, being a lender, that's a great business.
Do you hedge into that? I mean,
we do. Our business, most of our business is unlevered, but if we do have any kind of leverage in our business, we match ALM, complete asset liability matching all the way through.
So what's better for you now, right? Private or public? You said that private is sort of immune, and yet a lot of people think it's just not traded, so you can't see some of the carnage that you see in some of the IPOs of ARM and Instacart. So what's your view there?
Well, I think certainly if you look at an aggregate, it's hard to make money in the public markets and as an aggregate statement, equity and debt. Certainly with the valuations where they've backed out in terms of where rates are right now, a risk-free rate, yes, there's some opportunities in the investment grade world. But if you look at high yield indexes and leveraged loan indexes, they're arguably rich. They're rich for a lot of technical reasons. And so our ability, again, when we talk about private credit, most people, you talked about earlier, they talk about really the sponsor finance market. Right. The reality is, whether it's inventory finance, trade finance, solar finance, there's a massive $30 to $40 trillion opportunity in terms of the TAM. So that's where we're spending most of our time, creating great, safe spread yield, really on investment grade companies.
This sounds like a bank.
Well, I would say is we are a credit lender. We provide credit, and we do it in a manner where we're not using a balance sheet that we can lose deposits tomorrow. We have long tail liabilities, and we match those. A lot
of people have said, particularly in the banking sector, they're going after their lunch and that they have to follow pretty significant regulations, and you don't have to, and you have fixed capital. Yeah. And it's kind of what it sounds like in terms of the size and the scope that you need to achieve. It's kind of taking on a lot of the functions that banks used to fulfill. Is that the business model right now?
Well, I think our business model, so if you look at our $650 billion today, $350 billion comes from retirement services balance sheets, fixed annuities. The other half is the GP model. We're able to lend money to Air France, to Vonovia, the big German real estate companies. We can do that in a manner where we are solving the company's problems, and many times we're doing it in conjunction with an advisor or a bank. There's a narrative out there that we win, the banks lose, or vice versa. The reality is we are doing more in collaboration than we've ever done before. We have a big venture with BNP and inventory finance. They've got an amazing franchise. We partner with them so they can manage their capital in a more efficient way. But the reality is there's more collaboration. And people say, are you frenemies? Are you opponents? Are you competitors? It's all the above. We work very closely with them, and they work closely with us.
Should we make some news? There was a headline yesterday, Apollo looking to raise about $2.5 billion to lend in private markets, according to people with knowledge of the matter. We're talking to someone with knowledge of the matter, maybe. Yeah. Are you looking to raise about $2.5 billion to lend to private markets?
You know, we're an active player in the extension of senior loans to sponsors. We're active in many of these businesses. We've got a $425 billion credit business. The fact is, we built this business not expecting real yields and absolute yields to be at these levels. We thought it was going to be lower for longer. We created all these origination platforms. So the reality is today, investors around the globe are clamoring, and they're saying, wait, on a risk-adjusted basis, we can do this in the credit markets or in the debt markets. Why do we need to take that equity risk? And I think that's why you're seeing a preponderance of conversations about from sovereign funds to foundations to pensions around the globe saying we can make what we had to take equity risk in the past, we can do it on the debt side of the balance sheet.
I think that was a yes.
Was that a yes? Was that a yes, Bram?
That's a
yes. I think so, yeah.
You are looking to raise $2.5 billion.
We're raising we have a large platform. We're one of the handful of great players in the world. We're raising capital.
How does that work? Do you make like 6 phone calls? I mean, you know,
I travel quite a bit. If you ask my family, I travel a little bit more than those 6 phone calls. But, you know, we have several thousand LPs around the globe, and my schedule could be packed up going to visit them.
I can see Apollo PR right now. Jim, you were not meant to say yes. Just keep talking. Don't answer the question. Jim, let's go back to Spring. Spring was really messy. Banks failed in America. Yeah. And I remember sitting there, and we had guests come on the program with us on Bloomberg Surveillance, and lots of guests said, we've started a process here. It's the end of the cycle. There's going to be a hard landing. It's only several months ago. What was that?
I think it was a expectation of what was happening at that moment was going to happen completely. And the reality is, this is a big, broad global economy. The consumer plays a massive role in it. Back to my comment earlier about 3% mortgages on 30 years, the U.S. consumer really has not, we may have taken rates up, but the real impact of this higher cost, the second, the third derivative, it's early still. It's really early, and I think that's the difference between, there is no doubt the health of the U.S. consumer is what's allowed us to extend the economic cycle, but I think they're eating through some of their savings. And there's no doubt that there's the tightening of financial conditions is going to be out there. And, we're finding more companies coming to us trying to solve their financing needs going forward.
There are other firms challenged because they decided they were going to go off and do something different, new, original, and they're selling things for a haircut. You're probably involved in those transactions. How do you avoid worst practices? You guys have grown this thing from next to nothing. Mm-hmm. The private world is in right now. You're doing a brain drain. You're taking all the smart guys from Wall Street over to Apollo. Mm-hmm. Everybody knows the ballet. Mm-hmm. How do you avoid the worst practices we observe every day on the show where things blow up for Wall Street?
Well, the biggest accident you can do as you grow is to offer people liquidity on illiquid assets. Mm-hmm. And so I don't think it's a surprise. We're not in the business of offering daily liquidity in any of our products. We run our products, we really match the assets to the liabilities. And again, I think that's really a core to how we run our business. The second is for the last 6-7 years, we've continued to go senior in the capital structure. Mm-hmm. We're doing more investment grade companies. We're doing larger companies. Witness what we've done with, as I mentioned earlier, Air France or AT&T or Vonovia, big quality companies. So also when we underwrite something, for the most part, we bring in partners. We want others to take a look at what we've done. We're really good at underwriting credit risk. We brought a lot of that credit oversight that is so valuable at many of the financial institutions. But we have to make sure we're really measured and we focus on the 3 businesses that we're in right now.
Jim, what are you doing with the books that you already hold of debt and equity that is valued much lower?
Yeah.
I mean, it's one thing to talk about future lending opportunities.
Sure.
What about the ones you already did?
Well, let's talk about our business. So today of the $600 billion, equity is around 1/6 of our business, about $100 billion. We've been very, very clear in our private equity business in our flagship vehicles to fund more so with fixed rate debt and really extend those maturities. For the most part, we have been really not levering to the max. If you could lever companies 5-6 times, we typically borrowed about 3 to 4 times. So we didn't borrow as much, and we did it for term at fixed rates. That's a really important. What we learned in 08-09, it wasn't we were the smartest guys in the room, is that we had the best capital. And if you had the best capital and didn't get pulled away from the table, that's usually a critical aspect of success.
That takes us to our final question to wrap things up with you, Jim. In a world of high uncertainty and low confidence, do you have a high conviction call looking out in this market right now?
Well, I think that you have to assume, I think there's going to be what we call some big fat pitches out there. The reorganizing and the restructuring and the refinancing of the entire CRE universe. You have to be marshaling resources around that. You have to make sure that if you are lending capital today, you're doing so on senior basis with a tremendous amount of equity underneath you. So for us, I mean, certainly we're in 3 businesses. We've been very, very disciplined about what we've done. We have added a lot of human capital. It's been amazing for our company to pivot and grow, but really to make sure that we stay true to our alignment, our risk-adjusted returns, and making sure that purchase price does matter. We are very focused on the creation value of our businesses.
Man, you lost last night?
Is that what happened against
Bayern
Bayern
Munich?
Munich?
Is that an opportunity?
Is that an opportunity, to go to the Glazers? And
Yeah, they
ask
lost
for
to the
club?
Hurricanes. So
You really are trying to make some news.
Yeah, I'm trying to make some news.
Do you want to buy a
here.
football club?
We have an active we have an active lending business, and we've done a variety of things in the world of sports entertainment. But
You're on script.
we really
That's
are.
a no this time. I think that's a no.
Yeah.
Can we have a round of applause for
Yeah,
Apollo's Jim
thank you.
Zelter? Jim, thank you.